I'm also joined now by fund manager James Tierney of WP Stewart. WP Stewart owns over 1.5 million shares of Target. And Jim, you've had a chance to comb through some of these numbers. Would you agree that it's kind of a mixed report from the retailer, or what?
I think it's a pretty good report from the retailer. Target management is always very conservative. And I think if you look at the third quarter was very strong. And if you look at the fourth quarter guidance, Target management historically has been conservative, as I said. And you look at this year.
So you're saying this being cautious on the current quarter is nothing new. There's no news there.
Nothing new. And if you look at the fourth quarter this year, it's very different. Last year, consumers were retrenching, stores were over inventoried, the environment was highly discounted. And this year's different. Inventories are under control. Costs have been cut at Target, as at most retailers, and the consumer's coming back. September sales were better. October sales were better. So I think we're in for a better than expected Christmas.
Because just 3 months ago we were talking about how retailers were still in the doldrums and that shoppers weren't coming into the stores. So what has turned around in the last 60 days?
There are a couple of things. One, consumers have gotten a little bit more comfortable with spending. The stock market going up is a big deal, so consumers are feeling more comfortable. Comps are getting much easier. And the consumers have to spend at some point, and I think that's what you're seeing here.
Okay, inventory has been a big issue for the retailers. The Target, though, has generally been pretty good on the inventory structure, right? I mean, have they got it right for this period?
Target's been great historically, and I think that they have it right this time around.
Okay. John was talking about the cost structure, cost cutting. Target has done quite a few things over the last year or so. I mean, that could be part of the reason why the margins had been pretty healthy. But in fact, John was mentioning that the margins have come down just slightly for the third quarter. I mean, is their cost cutting now sort of right-sized with their growth or with their future?
I think the cost cutting for the most part is right-sized with their growth. Going forward, you need some revenue gains, and we're seeing the revenue gains. But you'll still have an underlying margin tailwind. Their private label product, Up and Up, is a big margin driver.
That's high margin.
Very high margin.
Okay, so they're going to be leaning more towards that later, or what?
They're going to have somewhat of an emphasis on that over the next few years. So continued margin gains at Target, in our opinion. Okay.
Revenue gains, though, where exactly are the big growth drivers for them?
Well, they're still expanding their store base and will over the next 5 years. So you'll see store growth. You'll also see some same-store gains come back because we haven't seen that for a couple of years. And that's starting. You're starting to see the customer traffic come back.
And oftentimes, when you talk about Target, you've got to also talk about Walmart. And these two stocks actually have performed kind of in opposite directions. Target's actually outperformed Walmart, but Buffett just upped his stake in Walmart. So is that a bad sign in a way for Target?
I don't think it's a bad sign. I think it's a sign of confidence in the retail business. One of the things that we've looked at, and we're very comfortable with the retail industry, is square footage growth in the retail business is going down. That's the first time in decades that U.S. square footage has shrunk. So I think it's very positive for the winners. And clearly, Target's a winner and Walmart's a winner.
Okay, Jim, good to talk with you about Target. Jim Tierney of WP Stewart.